You ever wonder what it really takes for a company to deliver knockout performance, not just for a quarter, but year after year? Well, let's take a look at a company that might not be on your radar, but whose numbers, they really speak for themselves. First up, bam, 13% year-over-year sales growth. That is a seriously strong double-digit number. Right off the bat, that tells you demand for what they're selling is just soaring.
But hey, sales are one thing, right? Is that growth actually profitable? You bet it is. That growth is dropping straight to the bottom line with a 10% jump in diluted earnings per share. That's the good stuff.
And here it is, the number that really tells the story, 33. That's how many years in a row this company, Badgermeter, has increased its dividend to shareholders. 33 consecutive years. That kind of consistency is just incredibly rare. So you see those numbers, and you gotta ask, right? How on earth do they pull that off? Well, I can tell you, it's not an accident. It's the result was a powerful and honestly a remarkably durable business model that they've been perfecting for over 100 years. So let's break it down. Where's all this cash coming from? Well, the lion's share, a whopping 85%, comes from what they call utility water solutions. What that really means is they're selling the essential, gotta-have-it technology from measuring water to thousands of towns and cities all over the world. And your business model? Oh, it's a classic. You've definitely heard of this. The razor and blade model. They sell the hardware, the physical water meters, the razors, which then locks their customers into years and years of high-margin recurring revenue from their software and data services. Those are the blades. And in the utility world, this is just genius because cities don't replace this stuff for decades. Once a city is in the Badger ecosystem, they are in it for the long haul. And this is how they've built an absolute fortress around the business. Think about it. For a city to switch providers, it's a massive headache and super expensive. Badger already has over 10 million of their endpoints out there in the world, a brand that's been trusted for a century, and they offer the whole shebang. Hardware, software, the works. It's an incredible competitive moat. And hey, don't just take my word for it. Listen to what the CEO has to say. He's pointing to this massive global push for smarter, more efficient water management. It's a trend so powerful that it just plows right through the usual economic bumps in the road. Okay, so everything sounds amazing, right? Almost too good to be true. And as smart analysts, we know every great story has a but. No business is invincible. So what could possibly go wrong here? What are the headwinds that could throw Badgermeter off its game? Now, when we talk about risk, you gotta separate the short-term headaches from the real long-term threats. On one side, you have temporary stuff like supply chain snags or inflation. Annoying? Yes. Company killers? Probably not. But on the other side, you've got the more serious stuff. What if a competitor comes out with some game-changing new tech? What if government standards change and favor a totally different system? And you can't ignore that they rely on city budgets, which, well, they can be pretty unpredictable. These are the risks you really need to keep an eye on. And all of this brings us to the final, and let's be honest, the most important question for any of us. We've established that Badgermeter is a truly wonderful company, but does that make it a wonderful investment at today's price? Let's just put it right out there, because this is what it all comes down to. Just because a business is fantastic, a real A-plus operation, does that automatically mean you should run out and buy the stock at any price? This is where we shift gears from talking about business quality to talking about valuation. So if we run this through a simplified kind of Buffett-style checklist, what we find is fascinating. On all the quality metrics, Badgermeter is a star pupil. It passes with flying colors, almost no debt, gushing free cash flow, super high returns on equity. But, and it's a big but, when you get to price, it fails the classic value test. It's trading at a price-to-earnings ratio of around 38, which is way, way above what a traditional value investor would want to see. A discounted cash flow analysis, which is another way to try and figure out what a company is really worth, tells a similar story. A pretty reasonable base case valuation suggests the company's intrinsic value is somewhere around $172 a share. But if you're a bit more conservative and you assume growth slows down, that value could be closer to just $82. And here's the real kicker. The stock right now is trading very close to that optimistic base case number. What that means in plain English is that the market is already expecting continued perfection. There's very little, if any, margin of safety baked into the price today. There's no room for error. So this leaves us with one of the all-time great investing questions. Is it better to buy a wonderful company like Badgermeter at a fair price, betting that its quality will win out over the long term? Or is it better to find a just okay company that's selling at a wonderful bargain basement price? With Badgermeter, the answer really comes down to how much you believe in that long-term story of smart water.
All right, before we wrap this up, just a quick and important reminder. All the analysis we've talked about today is based on public information and it's for educational purposes only. This is not and should not be taken as investment advice. Please always do your own deep dive and due diligence before making any investment decisions.